Hey guys, welcome to the full IT Bootcamp 2024-2025, and today's lecture we're going to be going over the stock market, which is an essential skill to learn in 2024 and 2025, and so on and so forth. So let's talk about the introduction to the stock market today. The stock market is a marketplace where buyers and sellers trade shares of publicly listed companies. It is a crucial part of the global economy, providing capital for businesses and opportunities for investors. Now let's understand what are stock prices. So you all may be already familiar with stocks. Today we're going to be going somewhat deep into the topic here. So the first one is supply and demand. Stock prices are determined by the interplay of supply and the demand. When demand for the stock is high, the price rises. Conversely, when supply exceeds demand, the price drops. This is self-explanatory. Then we have company performance, which like factors like earnings, revenue, market share influence investor confidence, affecting stock prices. Strong performance typically leads to higher prices. Then we have market sentiment, where we have investor emotions, news events, economic conditions can also impact stock prices, like different wars which go on all over the world. They can like make the market go down or go up. That really depends on the situation. Then we have other factors like interest rates, inflation, geopolitical events. They also play a role in stock price fluctuations. These factors can create uncertainty and volatility in the market. So, what is volatility? So, volatility is like how fast can the market go down or how fast can the market go up. So, that is basically volatility. Now, let's move on to the next slide here. So now let's talk about some different types of stocks here. So the first one is common stock. So common stock represents ownership in a company and grants voting rights to shareholders. These stocks offer potential for capital appreciation and dividends, which means that the price can go up and we can also have dividends. Then we have preferred stock. Preferred stock holders receive priority in dividend payments and asset distribution in case of liquidation. These stocks are typically less volatile than common stocks. Then we have the third type, which is growth stocks. These stocks are from companies expected to grow significantly faster than the market average. They often have high earnings potential but can be more volatile, which means that it can go very fastly up, but it can also come down. Let's move on now. Now the next thing is fundamental analysis. So what is fundamental analysis? Let's see it. Now the financial statements, analyzing a company's balance sheet, income statement, cash flow statement helps understand its financial health. The second is industry analysis, understanding the industry dynamics, competition, growth potential. It is crucial for assessing a company's future prospects. Then we have management analysis, which means evaluating the quality and experience of the company's management team, which provides insights into its potential for future success. So here what we can do is evaluate the quality of the company's management team, which can provide us insight into its potential for future success. Like we can get to know if it will go up in some time or go down. Now let's talk about the technical analysis. So we have different chart patterns here. Identifying recurring patterns on stock charts can provide signals about potential price movements. Here I have attached a chart for you. So this is basically like a line chart, as you can see over here, which I am marking, and these are the fluctuations in the market which are going on. Then we have the technical indicators. Indicators use mathematical formula to analyze price data, providing insights into trends, momentum, overbought or oversold conditions. Then we have trading volume. Analyzing trading volume can indicate the strength of price movements and potential shifts in market sentiment. Then we have the investing strategies. These are some of the investing strategies which I have brought up for you in today's lecture. So the first one is value investing. This strategy focuses on identifying undervalued companies with strong fundamentals and buying them at a discount. Like let's say that penny stocks can come in this category. Penny stocks, we can say it. Penny stocks come into this category. Then we can go ahead with growth investing. This strategy targets companies with high growth potential, often in rapidly expanding industries with the expectation of significant capital appreciation. Then we have income investing. This strategy focuses on generating regular income from investments, often through dividend paying stocks or bonds. Now let's move on to risk management. This is one of the most important aspects which you need to keep in mind while investing in the stock market. You need to apply every single one of this management to lower your chance of risk. So first one is diversification, spreading investments across different asset classes and sectors reduces overall portfolio risk. For example, we can invest in small cap, mid cap, and gold, silver, different types of assets, which will like spread our investments into different asset classes, which will reduce the overall portfolio risk. Then we have the dollar cost averaging. We can invest a fixed amount regularly. This is kind of SIP, which we call it. Regardless of market fluctuations, it can help reduce the impact of volatility. Then we have the stop loss orders. These orders automatically sell a stock when its price falls below a predetermined level, limiting potential losses. So let's take an example, like we have a company, Gurnur. We can take a company named Gurnur, which has a stock of, we can say, 100 rupees here, which has stock of 100 rupees here, and we bought 5 stocks here for 500 rupees. 500 rupees we bought 5 stocks, and we set a stop loss here. We set the stop loss to 90 rupees each. So as and when the stock would start to fall, when it reaches the point where touches 90 from 100, it will automatically sell all of the 5 stocks, and we would get back our money, which will be 450 rupees, as a loss of 10 rupees per stock. So this is basically what is a stop loss. So I hope you understood this, and let's move on to the next one. Now let's talk about some trading platforms and brokers. So first of all, we have online trading platforms which offer access to real-time market data, trading tools, and order execution capabilities. There are many of these, like Zerodha, for example. Then we have full-service brokers. These brokers offer personalized investment advice, research, and portfolio management services. These can give us investment advice too. And there was an app named Univest, I guess, and it is there right now also. It helps us to diversify a portfolio, and also it tells whether we should buy a stock or not. Then we have mobile trading apps. Mobile apps provide convenient access to trading accounts and market information from anywhere. Then we have discount brokers. So they charge lower fees for trades, appealing to investors who manage their own portfolios. Let's move on to the next slide now. So now comes taxes and regulations into play. So let's talk about them. So the first one we will talk about is capital gains tax. So the profits from selling stocks are subject to capital gains tax, with rates varying based on the holding period and the income level. The second one is Securities and Exchange Commission, SEC. So the SEC regulates the stock market, protecting investors and ensuring fair and transparent trading practices. Then we have Financial Industry Regulatory Authority, which is also known as FINRA. So FINRA is a self-regulatory organization that oversees brokers and broker-dealers promoting ethical business practices. Then we have Know Your Customer, which is also known as KYC rules. Brokers are required to verify the identity of their clients to comply with anti-money laundering regulations. Let's move on to the next slide now. And this is the final slide for today's lecture. Now let's talk about the conclusion and next steps. The stock market is a complex and dynamic system offering both opportunities and risks. With careful planning, research, and risk management, it can be a valuable avenue for building wealth and achieving financial goals. So I hope you find this session useful. If you did, drop a review down below, a 5-star review, and if you have any questions, drop down below. I will try to answer each one of them, and I will see you in the next one. Till then, take care and bye bye.